In 2017, MoviePass was losing $21 million every single month. And the CEO thought this was fine. He genuinely believed they'd figure it out. They had a plan. They had data. They had vision.
2 years later, the company was dead, and $200 million had evaporated. This wasn't fraud.
It wasn't incompetence. It was something far more common and far more dangerous. Your brain lies to you every single day. And it does it to protect you. It's called optimism bias, and roughly 80% of the human population has it.
Psychologist Tali Sharot at University College London has spent years studying this phenomenon. Her research shows that when people estimate their chances of getting divorced, getting cancer, or losing their job, they consistently rate their personal risk as lower than statistical reality, not because they're stupid. Because their brain literally processes good news differently than bad news. When you receive information that confirms your optimistic beliefs, your frontal cortex lights up and encodes it strongly. When you receive information that challenges those beliefs, the encoding is weaker. You literally remember the good stuff better than the warning signs. Here's how it shows up in everyday life. Imagine you're planning a home renovation. You think it'll take 3 months and cost £30,000. The contractor tells you projects like yours typically take 5 months and run 20% over budget. You hear him. You nod. And then you still plan for 3 months and £30,000. Because your project is different, you'll manage it better. You'll be more organized. Your brain has already decided the average doesn't apply to you. This isn't arrogance. It's biology. Daniel Kahneman documented this extensively in Thinking, Fast and Slow. He calls it the planning fallacy. When we're on the inside of a project, we focus on our specific plans and capabilities. We don't think we're ignoring base rates. We genuinely believe our situation is unique. And when you're building a business, this bias doesn't just cost you 3 months and £6,000. It can cost you everything.
In August 2017, MoviePass dropped their subscription price from $50 to $9.95 per month. Unlimited movies. Any theater. Any showing. The average movie ticket in America cost $9. Let's be clear about the unit economics. If a subscriber saw just one movie per month, MoviePass lost money on the ticket alone. Before salaries. Before technology costs. Before marketing. The math was broken on day one. And everyone knew it. Tech journalists called it unsustainable immediately. Wall Street analysts said it couldn't work. Theater owners were baffled. But CEO Mitch Lowe had a vision. He'd been an early executive at Netflix and a founding team member of Redbox. He knew disruption. He knew consumers. And he believed he could change behavior. The pitch went like this. Sure, we lose money on every ticket now. But we're collecting data. We'll know what movies you watch, what snacks you buy, what seat you prefer. We'll sell that data to studios. We'll negotiate bulk ticket discounts with theaters. And most importantly, people will sign up thinking they'll see unlimited movies, but they'll only average 3 or 4 per month. Just like gym memberships. This wasn't a scam. This was genuine belief.
Lowe's told investors that MoviePass would become the primary way Americans discover and consume movies. The average subscriber, he projected, would see fewer than 2 films monthly once the novelty wore off. By March 2018, MoviePass had 3 million subscribers, and the average user was seeing 5 films per month. Some power users saw 30. The company was burning $21 million monthly. But growth was intoxicating. The app was the most downloaded in the country. Lines at theaters had MoviePass users. Cultural momentum felt real. So they raised more money. Changed the pricing. Limited the selection. Eliminated popular showtimes. Subscribers got angry. Growth stalled. The cash burned faster. By September 2019, MoviePass shut down. Total cash incinerated. Over $200 million. And here's the thing. Mitch Lowe seemed genuinely surprised. In interviews after the collapse, he still defended the vision. He still believed that with just a bit more time, a few more tweaks, it could have worked. That's optimism bias. Not after the fact. During it.
Optimism bias isn't randomly distributed. It's actually stronger in people who are intelligent, successful, and experienced. That sounds backwards, but it makes sense when you understand the mechanism. Research by Dominic Johnson at the University of Edinburgh shows that optimism bias may have evolved because it encourages action. In competitive environments, overconfident individuals take more risks. Most fail, but the few who succeed do so spectacularly. because they attempted things others deemed impossible.
Evolution doesn't care about the 95 startups that failed.
It rewards the 5 that became unicorns. Your brain is wired for that lottery ticket. And success makes it stronger. If you've won before, if you were early at Netflix, if you've disrupted industries, your brain has evidence that you're someone who beats the odds. Mitch Lowe had that evidence. Netflix went from DVDs by mail to streaming dominance.
Redbox put kiosks where experts said they'd never work. He'd been inside 2 companies that looked crazy and became billion-dollar businesses.
So when investors questioned the unit economics, his brain didn't hear, "This math doesn't work." It heard, "They said Netflix wouldn't work either." This is where optimism bias meets confirmation bias. You seek out information that supports your vision and discount information that challenges it. MoviePass pointed to their user growth as validation.
3 million subscribers meant product market fit, right?
But product market fit at a price that guarantees bankruptcy isn't fit. It's free money. People loved MoviePass the same way you'd love a restaurant that charged £5 for unlimited lobster. The demand doesn't validate the business models. And here's the deeper psychological trap. The harder you work on something, the more your brain protects your belief in it. This is called effort justification. You've invested time, money, reputation. Your brain can't accept that it was fundamentally flawed from the start, so it finds reasons why it'll work eventually.
Just need more users. Just need better data. Just need one more quarter. Morgan Housel writes in The Psychology of Money that reasonable people can disagree about investment strategy, but you can't disagree with arithmetic. MoviePass tried to disagree with arithmetic, and arithmetic always wins.
Here's the twist. Some founders understand their business model doesn't work, and they use your optimism bias to raise money anyway, because investors have the same broken brain you do. In late 2017, MoviePass was acquired by Helios and Matheson Analytics, a data firm. Helios CEO Ted Farnsworth saw MoviePass differently than Mitch Lowe. Lowe believed in the vision. Farnsworth saw a stock promotion. Helios was a penny stock, trading at around $20 per share. After announcing the MoviePass acquisition and the $9.95 unlimited plan, the stock shot past $38. Farnsworth sold shares. So did other executives. Millions of dollars in personal profit, while the company bled cash.
They used press releases about subscriber growth to pump the stock.
They announced partnerships that were exploratory at best. They talked about future revenue streams that didn't exist. And investors bought in. Not because the math worked, but because the story was compelling.
This is optimism bias weaponized. Venture capitalist Bill Gurley has talked about this dynamic in Silicon Valley. When capital is abundant, investors develop FOMO, fear of missing out. They see MoviePass's growth and think, what if this is the next Netflix? Lol. What if I'm the idiot who passed on it? So they fund businesses with broken unit economics, hoping that scale or pivots will somehow fix fundamental problems. That's not analysis. That's magical thinking dressed up in a pitch deck. But here's the truly dangerous part. This sometimes works. Amazon lost money for years on retail because Jeff Bezos was building infrastructure for future profit. AWS eventually subsidized everything else. Uber lost billions but changed transportation behavior and built network effects that created defensible moats. So when does optimism bias lead to Amazon, and when does it lead to MoviePass? The difference is whether the losses are investments in future structural advantages or just losses. Amazon's losses built fulfillment centers and cloud infrastructure. Uber's losses built driver supply and rider habits. MoviePass's losses bought movie tickets. There was no accumulating asset, no moat, just cash flowing out the door, every single month, forever. Robert Cialdini explains in Influence that commitment and consistency make people double down on failing courses of action. Once MoviePass publicly committed to $9.95 unlimited, they couldn't back out without admitting the model was flawed. So they kept going, kept raising, kept burning until they couldn't anymore. So how do you pursue ambitious goals without becoming MoviePass? How do you stay optimistic without being delusional? First, separate the question, can I? From the question, can anyone? Before you assume you're different, check if anyone has made your business model work, not someone with more funding or better execution. Has anyone ever
sustainably made money with your unit economics? If the answer is no, you need a fundamentally new insight, not just operational excellence. MoviePass wasn't the first unlimited movie subscription. They all failed because the economics don't work. Unless you own the theaters or negotiate bulk discounts that restructure the entire cost base, selling someone else's product for less than you pay for it is called a charity, not a business. Second, use pre-mortems, not post-mortems. Psychologist Gary Klein developed this technique. Before you launch, imagine it's 2 years in the future and your business has failed catastrophically. Now write the story of what went wrong. This forces your brain to overcome optimism bias and consider realistic failure modes. When MoviePass did this exercise, if they were honest, they'd write, "We failed because users saw more movies than we projected, and we couldn't reduce costs fast enough," which is exactly what happened. Third, track your assumptions and test them cheap. MoviePass could have run the $9.95 model in a single city for 3 months before going national. They would have seen immediately that users consumed far more than projected. Instead, they scaled losses. They turned a hypothesis into a commitment before they had evidence. This is optimism bias in action, believing so strongly that you skip validation. Fourth, have someone in your circle whose job is to kill your darlings, not a yes person. Not a skeptic who kills everything, but someone psychologically positioned to challenge your assumptions without ego. Venture firms sometimes call this a red team. Their job isn't to be right. It's to force you to defend your thinking with evidence, not enthusiasm. And finally, remember this. Optimism bias kept our ancestors exploring beyond the next hill. It's why we have civilization. But your ancestors who explored without packing enough food? They died. The goal isn't to eliminate optimism. It's to pair it with arithmetic. You can believe you're going to change the world. Just make sure the math supports that belief before you bet $200 million on it. Because here's what we haven't talked about yet. Mitch Lowe still got paid. Ted Farnsworth sold stock at the peak. Venture capitalists wrote off their losses and moved to the next deal. But employees lost their jobs. Customers lost a service they loved. And that $200 million could have funded 100 sustainable businesses instead of one spectacular failure. Optimism bias doesn't just cost you money. It costs opportunity. If you want to understand more cognitive biases that cost people millions, subscribe. We break down the psychology behind every major business decision. Next video explores how confirmation bias turned Blockbuster's logical decisions into a death sentence. See you there.